earnings season. We have most of the companies reporting. And for me, I thought this is an interesting trend because even with Zoom, you see Zoom blow out the quarters, you see all the FANG stocks blow out the numbers. The analysts have been so dead wrong. And I wanted to really look into researching this part. And so, guys, this is one of the, I bring this up a lot. It's one of the best free sites. So if you go to, FactSet, I just type in FactSet in Google PDF earnings, and they produced this page right here, which I'm showing. Again, if you're watching this on video, the Curzio Research YouTube page, and it's a 31-page report, and they publish it, I would say, every 7 to 10 days, maybe. And they break down everything in here. So I'm wondering, what's going on with and one of the things I noticed is that it says 96% of the companies at S&P 500 reported actual results. 79% of S&P 500 companies have reported a positive earnings surprise. So if 79% is the final percentage, it will mark the third highest percent of S&P 500 companies reporting positive earnings per share numbers since FactSet began tracking this metric in 2008, right? So you're seeing positive earnings surprise, which is okay. It's a crazy market. People are coming back quicker in some areas than others. I get it. But then when I look at 9 sectors have higher earnings growth rates or smaller earnings declines today due to positive earnings per share surprises. 9 sectors. That's huge. That's a lot. So they talk about the 12-month PE ratio right now. It's 21.5, and that would be expensive if you're looking historically or whatever you look at. But to really put in perspective, you really have to compare because this time is different. People say it's not different. We have zero rates basically across the board, and you're throwing trillions into the market 21 times. Not really expensive, as crazy as that sounds. But more important here, Daniel, before I get in here, this was a big thing I wanted to find. So second highest increase in S&P 500 earnings estimates since 2002, and this is for this quarter. So they say during the first 2 months of the quarter, analysts increased earnings estimates for companies at S&P 500 for the quarter. They increased it by 5%. Right? Now, what does that mean? Because they say, how significant is 5%? How's it increased compared to past quarter? Well, during the past 5 years, the average decline in these earnings. So leading up to the quarter, usually analysts come out and they say, they lower those estimates a little bit. This time they raise them by 5%, right? So during the past 5 years, the average decline was 3.5%. Past 10 years, average decline is 3.2%. And the past 15 years, the average decline from these analysts, again, the first 2 months leading up to the quarter, they usually lower estimates by 3.8%. This quarter, they raise them by 5%. Now, what does that mean? It says the first quarter marked the second highest increase in bottom-up earnings per share estimates during the first 2 months of a quarter since FactSet began tracking this metric, and this goes back to 2002. I want to bring this all together before I bring you in because this is important to understand, guys. So analysts are raising their estimates by the largest amount almost than ever leading up to the quarters, and these companies are still blowing out these estimates higher than, in the highest bracket percentile that you could possibly use. What does that tell you? It tells us that if you're looking at earnings for S&P 500, this is S&P 500 company earnings we're talking about with FactSet, you're going to see an explosion here. These guys are ready. We're looking at economies that aren't even fully open, right? Or states that aren't fully, cities aren't fully open. Everything's going to be opening up, especially over the next 3 to 6 months as these COVID rates are declining. These plunging, hospitalization rates are plunging. Amazing. Great news. More people are going to go out, more people are going to spend, and you are going to see a surge in earnings. As earnings go higher, if the S&P 500 stays the same or goes, grows slower, goes up, slower than the earnings growth, the PE ratio goes down. So these stocks might not be 21 times earnings. So if S&P 500, let's say, just stays the same and these earnings rise a ton, you're going to see that PE ratio overall for S&P 500 come down, which I don't think is unexpected. And more important, what does this mean, Daniel? To me, it screams inflation. Inflation is going to be here. If these guys, analysts can't keep up with how fast these guys are growing earnings right now. They can't, right? Yeah. So it's pretty insane when you think about it, where it just looks at inflation, Bitcoin, you're wondering why it broke through 50 again, 50,000, gold, I think is a great, but for me, when I look at earnings on the macro level, this is a pretty big deal. But again, you follow earnings, you track all the earnings reports for all the stocks in our portfolios and stuff. But I want to get your thoughts on it. And sorry I was so long-winded there. But
no, you're good. Yeah, we were joking about this yesterday. We're not out of the woods yet on earnings, but we didn't really have a company that dropped significantly. We had a couple biotech stocks be volatile, but hell, that's natural for those. So we were kind of joking about that. We didn't get smacked on in earnings, and if we did, it came right back up. That's just the bigger picture of that. I actually would love to see the forward PE drop a little bit, not for the wrong reasons of prices declining or staying flat while inflation gets here. That's going to pinch the individual investor and the consumer. But something's got to give here. I mean, you can't, if analysts don't raise those higher, you don't want to let them hit the ball out of the park too often. You want to be accurate in your job. And I know they work hard and try. But the other side of that is, when is enough enough? When is the mindset going to click and say, hey, we may need to move some cash? We've talked about rising interest rates last week, about how the 10 years getting to 1.5, which is the same dividend rate roughly as the S&P 500. But the big picture there is, hey, you can't, or I'm not saying you can't, you don't want to have a market. We're 20% higher than the 5-year average on the forward PE of 21.5. That's a hell of a lot better than if it's at 30 or 40 or you get into the dot-coms and all that kind of issue. So I want it to level off, if not drop a little bit, because I don't want the extreme volatility that we've been having, like the Friday to Monday that we had over my trip. It's always good when you're traveling and the market's going up, but I would rather have more of a steady growth and analysts back and forth than the ridiculousness that we're seeing.
Yeah, and guys, just to put this in perspective, okay, when you watch CNBC and it says IBM reported earnings and they beat, right? They beat those estimates. When they're saying they beat those estimates, they're beating the estimates, not the company estimates that some of them provide. A lot of them aren't providing because of COVID still. Target said we're not providing it. Some of the retailers said we don't know. It's a crazy environment. Even some of the home builders. But say probably 35, 40 analysts that cover Amazon, right? These are institutional analysts. When I say analysts, it's not us. We're buy side. This is sell side analysts. So these are the institutions like JP Morgan, Goldman Sachs. So then they take the consensus out of all of those, and that's the estimate they have to beat. So if all the analysts decide that there should be a lower number, it provides an easy beat. So you could see revenue grow or say earnings grow. They'll come out and say this company beat earnings estimates. They blew them away like Nordstrom did. But yet same store sales were down 20%. So they beat the analyst estimates, but the comparison year over year is still horrible, but they just beat the analyst estimates, what everyone focuses on. That's what we're talking about here. Analyst estimates are significantly conservative right now. They've been, go back and look at what Microsoft reported. Go back and look at all the FANG stocks and what they reported. If you look at even Facebook, you look at Amazon, all of them, they blew out the numbers by 30 to 70% on earnings. That's unheard of for a big company to and same with Zoom. They're just so behind the curve on the growth that some of these companies are seeing in earnings and sales and everything else. And a lot of that could be due because they're not tracking cost cutting as much. So, you're seeing, you're going to make more money per dollar, right? Per sale. If, you have 100 million in sales and your margins are going to go up tremendously if you're cutting costs, right? So your earnings could go from, $1 to $2 and have the same revenue because you cut costs tremendously. I don't see that factored in, Daniel. I don't think that's factored in.